I would like to welcome you to this webinar on the 7 myths of venture capital, tips for new and aspiring entrepreneurs with Mike Lepech and Ashmeet Sidana. Mike is an associate professor of civil and environmental engineering and a senior fellow at the Woods Institute for the Environment at Stanford University. He is also the academic director of the Stanford I2M program. Ashmeet is a longtime venture capitalist and is the founder and chief engineer of Engineering Capital. His experience includes managing venture capital funds, CEO. He serves on multiple boards and is an experienced entrepreneur. Ashmeet received his MBA from the Wharton School of Business. He has a MS in computer science from Stanford University and a BS in computer science from USC. Ashmeet is an action traveler and has summited Mount Everest. For more information about Mike and Ashmeet's experience, please check out Stanford Online web pages. With that, I'm going to hand the webinar over to Mike and Ashmeet. Mike?
Thanks, Anita. Ashmeet, it's wonderful to join you here today. I know that today we truly have a global webinar in that you're joining from your home in beautiful Palo Alto, and I'm joining from Seoul right now. Traveled here yesterday to work at our research center focused on smart cities. And so we truly have a global presence for this webinar. So one of the things that I wanted to talk to you today about were some of these myths about venture capital. And I think that venture capital is one of those very sort of mythologic jobs. It's such that people don't know exactly what it is, but it sounds very cool and almost has sort of a romantic view to it in that, oh my gosh, you're picking these companies you're taking up through, there's billionaires and private jets and all these other things. And what we want to try to do here is, number one, talk to an actual venture capitalist and talk a bit more about maybe, walking back some of those myths about what venture capital is and about what venture capital, more importantly, is not. And so we'll kind of do this David Letterman style, for those that remember David Letterman late night, except he needed top 10 reasons to get through any specific topic. Here we think we can do it in 7, and so we'll try to get there. So the first, so first of all, welcome Ashmeet, and it's really a joy to be here with you.
Thank you, Mike. It's a pleasure to be here.
So, let's start with number 7, right? A VC's job is to help you. Isn't it the job of the VC to help you?
That's a great place to start, because that's a pervasive myth that VCs like to promote. VCs like to project that they are there to help you. That's their job. That's the marketing and the advertising that many venture firms do. Unfortunately, that is not the job of a VC. People walk into venture firms, and I've had entrepreneurs directly tell me, well, you're going to help me recruit employees, right? Or you're going to help me get customers, right? Or how many people are you going to help me get a partnership going with? And those are fair questions. And VCs will help in all of those ways, in some ways, but that's not the job of the VC. A VC's job is an investor's job. It is to make money, in other words, to buy low and sell high in a company that an entrepreneur is starting. And that is the primary focus of the VC. And I think entrepreneurs and VCs relationships sometimes get waylaid when entrepreneurs don't understand that while a VC may help you as a part of making themselves successful and making themselves a great investor, their primary job is not to help you.
Yeah. Well, and given the structure of the cap table, I mean, incentives are aligned. The VC only does well if you do well, but there is absolutely a separation of duties and good corporate governance in that, the VC is very much like a member, or actually officially a member of the board of directors at a company, which it is not the member, it's not the board of directors and members of the board to help the CEO, find employees for a large Fortune 500 company or any size of company. There is that separation of powers in good corporate governance. And I think what you're saying is you have to view this in very much the same way.
Absolutely. At the formal level, you're right. There's a separation of powers. There is a governance system that is implicit over there. But also in a more subtle and a nuanced way, you can see people get misaligned. And here are two great examples. When Uber was on its hypergrowth trajectory, Benchmark, very high quality early stage firm, was an investor on the board. And eventually Benchmark sued the CEO, the founder CEO, Travis. So threatened to file a lawsuit, showed up, in front of his hotel room at 8 o'clock at night in Chicago. There's a lot of stories about this, and they're all true. Mm-hmm. All are not true, but there's many of them are true about what happened. And that's a case where you had a board member actively working against a CEO. And I think that starts to tease apart, where this relationship can end up. They all don't end up there. Hopefully you'll stay aligned. Hopefully you will build large and successful companies. But you do need to start with this premise that the VC has a different role and you have a different role as an entrepreneur.
Yeah, absolutely. But you're exactly right when you say that there is this myth that, oh yeah, this is going to be somebody who's going to work for me in addition to giving me some money and allowing me to build my company. They're going to be just a part of the working team. Not exactly.
Yes.
Not exactly.
It does happen in the ideal case, but not always.
For sure. And then I guess that ties in with, recognizing that different VCs are talented in different ways and have different skill sets. And so I know we're going to get a little bit later to some of the types of advice that a VC can give you, but they may not even be able to offer you the kind of help that you may need or think that you need at that time.
Exactly right.
Yeah. All right, number 6. A VC will tell you why they actually passed. They won't?
This is another myth. People will say that, XYZ told me that, this is why they passed. Passing, of course, refers to a VC declining to invest in your company. And entrepreneurs will sometimes, to their credit, ask a VC, why did you pass? Why are you not investing in my company? And there are rare occasions when VCs will tell you the actual reason. And there are even rarer occasions where they will tell you the complete reason on why they passed. But that really is rare. The VC's incentives, unfortunately, are not aligned to sharing that information. At the simplest level, venture is an investing job. There's an information asymmetry. And so you don't want that information to go out there. A VC does not want to share exactly what their thought process is, what their investment criteria is, how they evaluated someone. A nicer and a benign reason is that a VC may just want to keep a relationship with you. They don't want to hurt your feelings. They thought the CEO wasn't good, and they don't want to tell them to their face that they didn't think they were good. And so it could be something as simple as that. But there are also many more reasons which range the gamut of, the partner has a different agenda, the firm has a different agenda, the strategy is changing. There are venture firms that in the business we like to call the living dead. In other words, venture firms that don't really have more capital to deploy, that are just taking meetings to keep their reputation, to keep their presence in the market in the hope that they would raise a new fund in the future. And there are pernicious effects like that do pervade the market. And so it's very hard to find out the real and actual reason why someone passed. Now, obviously, if you could find it out, it's very useful information. So I always encourage my entrepreneurs to go and ask. You have nothing to lose. But whatever you hear, take it with a pinch of salt and try to collect multiple data points and then try to triangulate and see what is the real reason. Is there some learning in it that you can get because this is the reason why the venture firm passed on you? My rule of thumb is you need 10 no's to really figure out what's going on in the market. And here's a piece of advice. If you already have an investor who you can trust, who is a VC or who knows how the venture community works, a great way to find out why someone actually passed is to ask them to do a back channel. In effect, a reverse reference, and say, okay, hey, John, you passed on my company. Can you let me know why? And often a VC, out of professional courtesy, out of a relationship which hopefully your existing investor has built with the firm, will be able to glean some more truths over there. But again, that is with the caveat that it should be taken with a pinch of salt and is probably not the complete truth on what actually happened over there.
I think it's interesting that you're talking about the living dead, and we talk about zombie companies very often. Those that are just kind of hanging on, but they can't get that next round, and nothing seems to be moving forward. And we don't think about the flip side of it, in which there are sort of the living dead or zombie venture funds, which as you said, don't have any more capital to deploy, but they're looking to raise that next round. And because all of this is so much about reputation and about that ability to bring in the next really great founder, they need to keep that up. And so it can be somewhat confusing to say, gosh, I thought you really liked my company. I thought things were really going well, and yet you couldn't write a check. Well, or you didn't write a check. But in honesty, you couldn't write a check. And that's really interesting.
That's exactly right. They couldn't write a check even if they wanted to. And the problem of zombie firms in venture capital is particularly bad because traditionally venture firms are raised with a 10-year fund cycle. And as long as you are an active manager, you get paid fees for those entire 10 years. In other words, you're getting an income from the fund. And so it is your interest as a VC to pretend that you are active, to keep drawing on those fees, which can be substantial if there are substantial funds, even if you don't intend to raise another fund or you don't want to do it. Now here, of course, I'm clearly impugning the objectives of someone who behaves like that and the motives of someone who behaves like that. But look, we're all human, VCs are human, and we suffer from these weaknesses. And I think it would behoove an entrepreneur to recognize that that could be going on in the market. I should also add that right now we are in a very positive market for venture capital. We've had a great bull run for the last 10 years. The market has been up and to the right. It has accrued to the benefit of venture capital. COVID was obviously an enormous tragedy in huge parts of the world, but it actually helped venture capital and technology in some ways. And so if anything, it has even further accelerated the flow of capital towards VC. And so I think the problem of zombie firms is actually not so bad right now. But if and when the market corrects, and believe me, the market will correct. We just don't know when. I can guarantee it will correct. The only question is when. At that point, I think this will become once again a very big problem.
Yeah. No, with interest rates being so low, there is so much liquidity looking for any kind of return, even though it might be something very risky, like investing in a venture fund. That you're right. It has been that market, and when it will correct, and we've seen it a few times in the sort of the Silicon Valley space, it will be challenging. I think one of the other things that you had said was you always want to be nice to people who are coming in and pitching to you because you never know if they're going to be the person coming to you with that next great idea. And so you want to build those relationships over time. A question came in about specifically, and since we're talking about why you would pass or why you might not pass, advice to female founders of tech companies, particularly coming from Latin America, but more generally to female founders. What are you looking for in this type of profile?
So, my perception is that it's unfortunate, but female founders do have a higher bar or a higher burden just because of the nature of society, just because of the social norms that we live in and the expectations that have developed. I think the good news is that there are VCs who are working actively to correct. There are people who are very aware of this issue. And so there are both sides to this coin. But net, I would say today, there is a higher bar and a higher burden that they just need to be aware of when they walk into the market. This is a marketplace for ideas. It's a marketplace for money when you're talking to VCs. So you have to be aware of it. My mentor, the person who I owe the most to being a VC, was actually a woman, Catherine Gould, who was one of the very first GPs in Silicon Valley and was the founder of a great firm, helped me start engineering capital eventually, and just a fabulous venture capitalist, and a woman who started a venture firm because she was unable to become a partner in a great firm and felt that that was the only alternative left for her. And so she definitely, had a chip on her shoulder. And she would often get this question because just by virtue of being a woman VC, a lot of women entrepreneurs would walk in. And so you would meet a lot of women entrepreneurs. And her advice, you could simplify it down to saying that the best course of action is for female founders to be relatively oblivious to this distinction that exists. Your job as an entrepreneur is to do your best. Making yourself more aware of this issue is not going to solve the problem. If your goal is to solve the problem, then there are better ways to solve it. In other words, you could become a politician, you could become a lawyer, you could become a social activist, you could become a journalist. There are many ways in which you can address these issues that are more effective and probably will have a greater impact faster. By being an entrepreneur, you are simply setting an example. And your job as an entrepreneur is to succeed and build your company. That's job one, that's job two. That is the most important thing you can do for yourself and the world, is if you can make that company successful, if you're an entrepreneur. And so once you make that leap, then it just reduces to what does it take to make your company successful? What is the best course of action that you need to take to make your business and your company successful? And whether you're a female entrepreneur, an entrepreneur who has comes from a different background, a non-traditional background, is in a non-traditional location. You mentioned Latin America, obviously, which is obviously a non-traditional location to those of us who are sitting here in Silicon Valley. But those are giant markets. Those are emerging markets. Those are fast-growing markets. And that's often where there's more opportunity. And so you just have to play by the rules of the game as they are placed in front of you and do the best you can.
Yeah, definitely. So a quick funny question that kind of came in that is a very interesting question. Very often I know that there are investors that kind of a few years in think to themselves, oh man, I don't know if I invested in this company correctly. I don't know if this was a good, we all have a little bit of buyer's remorse from time to time. And then one of the questions that came in as a founder, is it possible to lay off a VC if you don't want them anymore? That gets a little harder with the cap table.
Yes, very, very hard. The way I say it is there is no undo in the venture business. As an investor, once you make an investment, you are pretty much committed. And you're not going to get to back out of that. Similarly, as an entrepreneur, once you've selected a VC and you brought them onto your cap table, there's no undo. You cannot fire an investor. You can fire a CEO, you can fire a VP, you can redo the entire management team, you can change your product, you can pivot into a different market, you can do all kinds of things. But those cap tables are pretty rigid. And can become boat anchors in some cases. And they are definitely a source of stress. And that is why reputation is so important. That is why diligence on both sides is so important. Just like we do diligence as VCs before we make an investment, I always advise my CEOs, go call some people off the list. In other words, not the reference list that the VC gave you, but go call some people that VC worked with in the past and see what they say behind the back of the VC. And you will learn a lot. You will learn whether that is the kind of person who you want to work with, that is the kind of person who you will be aligned with for the long haul. Firms have reputations in addition to partners. There are firms who are friendly and there are firms who play tough. There are firms who are playing for the proverbial home run. And there are firms who are founder friendly and will accept, perhaps a less than optimal outcome because that's the best strategy for them. And you need to understand that as an entrepreneur before you accept that money. Because once you take it, you're pretty much in it for life.
Well, and that also I think speaks to one of the other questions that came in, advice for idea stage founders. Be careful who you're working with, even very early on. and to say, hey, to your cousin, to a friend, to somebody in the family, hey, I'll give you half of the company if you do X, Y, and Z for me, because at that point they're an investor as well in many regards, because they will be on that cap table and they will be there forever. If it's structured that way. And so you want to be very careful very early on with making sure you're thoughtful about who you're going to bring in and what you're going to offer. It's an incredibly important point.
Yes, Mike. And the way I think an entrepreneur can simplify this is that, your job obviously as an entrepreneur is to build a profit and loss and a balance sheet. Everybody thinks of a business in terms of consisting of a P&L and a balance sheet. I'd say, well, you're really managing three statements. You're managing your P&L, your balance sheet, and your cap table. And you have to be thoughtful about how you are going to grow it. There's only 100% to go around. That 100% can never change. And it really has to survive the life of the company. And so how are you going to husband the growth of that cap table through eventual success? Whatever your definition of success, an IPO, an M&A, there's only 100% to go around over there. And it becomes a zero-sum game very, very quickly. And then you are at odds. You are sitting on the opposite side of the table from someone who was your friend yesterday, and it's very uncomfortable. That leads to very, very difficult conversations.
Indeed. All right, let's get back to the list. We're at number 5. A VC turning you down means something's wrong with your business. That's not true.
This is a huge myth, and one I wish every entrepreneur would take to heart before they followed my advice on the previous one, which is, go get feedback and learn what the VC is saying. If you remember my answer to the previous question, you have to take what the VC says with a huge grain of salt. And so that applies to them saying why they passed, me implying something wrong with your company. In other words, don't over-rotate on the feedback that you get from a VC. Sometimes entrepreneurs will say, oh, they told me my go-to-market is bad. Well, that's the reason they gave you why they passed. That doesn't necessarily mean your go-to-market is wrong or bad or is not appropriate for the way you want to build your business or for the product that you've done. They may not have even understood your product. They may not have even understood your strategy. Or even if they understood it, they may not agree with the risk-reward trade-off of that strategy. Even if they agreed with the risk-reward trade-off with the strategy, they may have chosen not to participate in that because of other preferences that they have in their fund or other companies that they have in their fund, completely unrelated to you. In other words, if I'm a large fund and I've just taken 10 consumer bets, I may not want to make the 11th consumer bet. I may want an enterprise bet for the 11th one. It has nothing to do with you having a wrong or a bad approach to building your business. And so it's important for an entrepreneur to have the courage of their convictions, to be able to derive from first principles that they are building a good business for the long term. VCs are famous for being pattern matchers. They are making quick decisions. They are trying to, build a portfolio on their side. And that is not what you are doing as an entrepreneur. As an entrepreneur, you are building a business ground up, bottoms up, step by step for the long term. And following a non-traditional or an unusual path is actually many times the right thing to do. It is the way in which you will build a disruptive company. And so be very cautious when a VC says that you are doing something wrong or interpreting that as necessarily wrong for you. Simply take it as one data point out of many available to you to learn about your business, to learn about the environment. Yes, that is their perception. Yes, that is how, one smart person sitting in one firm who spent an hour or two with you thought you were doing. But you're doing that 24 hours a day for years at an end. And there are lots of examples of companies that were not understood by VCs early on. The entire open source landscape is littered with VCs who thought they would never build a big business. Let's take the very first successful company, Red Hat. Red Hat was recently acquired by IBM for $30 billion. The biggest acquisition in IBM's history. I mean, $30 billion is a massive outcome. And here's a company, obviously in this case, a public company and a very old company that had been around for a long time. But it started as an open source company. All their products you could download from the internet for free. And yet they built what was eventually a $30 billion outcome over here. So there are many ways to build a company. There are many ways to build a business, and you have to be creative.
Yeah. Well, and one of the things that I think you had, one of the words you had used, I think that is so important for people to understand, is portfolio. You know, much like for all of us, we have a personal investing portfolio where you're going to invest in some stocks and some other things, and you're trying to create a mix of investments for which you feel that you're going to get a good risk-return ratio. And that doesn't mean there aren't hundreds of other great companies out there on the stock market that you could buy. And in many regards, they might be just as good. However, if you've already bought one of those other competitors of theirs, you may not want to allocate more of your capital and sort of, you know, double down on that one bet. The venture capitalist is very much, as you've said before, is an investor, and investors manage portfolios. And so you also have to understand that there may not be something wrong with you, but rather you're just duplicating a part of their portfolio, and they would choose not to do this any longer. I guess maybe as a follow-up to that, when a venture capitalist says, you know, I really am going to have to pass on this, but maybe you should go talk to this other fund. Are they giving you an honest recommendation that they think that other fund might invest in you, or are they just kind of passing you off to kind of get you out of the office, and at least I sent them on their way with some nice piece of information?
Like all human communication, Mike, the answer depends. You know, there is no silver bullet that anyone has developed. Otherwise, you know, we wouldn't need a justice system and courts and journalists and investigative reporters and, you know, all of this work to get to the truth of the matter. And I think ultimately, of course, this becomes a philosophical question, and, you know, what is the nature of truth? But the answer depends. You know, I have seen VCs who will go out of their way to be helpful and will genuinely give you feedback. And then I've seen VCs who can be quite cynical about it and would, you know, want to take advantage of the situation and perhaps abuse the trust that you may be placing in them. And so, like, you know, any human population, it ranges, there's an entire range of people, and you as an entrepreneur have to make an evaluation, a judgment of what it is that you are receiving with due caution over there. VCs do keep a lot of contacts, you know, that's part of our job. And so we can give you insight over there. I will tell you, having been a practicing VC now for over a decade, that our fear on the other side of the table is that many times entrepreneurs actually don't want to hear the truth. Many times entrepreneurs are not receptive to really what they would be able to get. And so it is in our interest to be, to demur, you know, to just be quiet and to avoid a confrontation. There's no reason to create a confrontation there. And so VCs will sometimes take the low road in that sense, rather than taking the high road, or you could call it the high road, I guess, by just staying quiet over there. And so what I would tell entrepreneurs is, if you can somehow communicate to the VC that you are genuinely looking for their best recommendation, their best advice, then you may get a better answer. But at the end of the day, you will have to evaluate, you know, how much weight to put on that recommendation and that answer.
Yeah, no, you're right. It always depends, right? I mean, what kind of relationship have you built through those first few discussions, and whether or not they think that you're somebody worth spending more time with, and to give you that advice. Yeah. All right, number 4, and this is one that I think is indeed a huge myth around the world, certainly around Silicon Valley. VCs are rich. VCs aren't rich? I mean, come on.
Well, you know, there are certainly some VCs who are rich, but there are also many VCs who are not rich. And I think it's important to understand that for an entrepreneur who's walking in, who is hoping to build a relationship with a firm and with a person, let's first separate, you know, whether an individual is rich or whether a fund has money. Which is the money that they are going to invest in you as an entrepreneur. Those are not one and the same thing. You know, a fund is a distinct, separate entity in which there are LPs, limited partners, who hopefully and presumably are rich, who have invested in that fund. whether through a foundation or endowment, whether it's a pension fund, or perhaps even a high net worth individual who has invested in that fund. That is the money that is being invested in companies. That is distinct and separate from the individual who is doing the job of a venture capitalist who is investing that money. Venture capital can be a lucrative business in the long term. And so if you're a good VC, eventually you should be rich. That's part of the returns of that job. But many VCs are not rich, especially VCs who are junior, younger, working at large firms is where you see the maximum disconnect that happens. And I have seen it lead to some awkward situations. If you can be a Stanford MBA who graduates and becomes a principal or an associate at a very large venture firm, and yes, you get a nice salary, but you haven't become rich overnight. You just got a job at a large venture firm, which is perhaps managing billions of dollars. And I was personally in a dinner once where someone ordered $1,000 bottle of wine, just as part of the dinner, part of the conversation that was going on. And I think it was very uncomfortable for the other person because it was inappropriate. I don't think the entrepreneur had recognized that, that's a very large purchase relative to a casual dinner that someone may be doing. Now, there are lots of VCs who wouldn't think twice about spending $1,000 on a bottle of wine. But there are many VCs who will remember that. And I certainly noticed the look of chagrin on people's faces when that happened. And so you should not presume that. I think that's incorrect. And just understand that we are just normal people who are doing a job in a different line of work, who are in there, who, depending on the stage of career they are on, may be at different stages of wealth creation for themselves.
Right. Which is not to say that a junior investor doesn't have money to invest. They absolutely have decision-making power and things like this. And that goes to that separation between whether or not they have investing capability or capacity on behalf of the fund versus their personal checkbook. And such that, when you just start investing as a personal investor, say in the market or anywhere else, you're not going to have a lot of money because you're a new investor. And yet over time, you do create that wealth for yourself, but that can then balance that lifestyle. Indeed.
Mike, it's a really good point. And I'm going to insert something that you and I didn't discuss before, which I want to use this to build on, which is venture is one of those rare areas where when you are selling, remember, when you're pitching a VC, you're basically selling your stock, you're selling a portion of your company. It is one of those rare industries where when you are selling, I don't recommend that you necessarily sell high. The traditional advice when you're selling is to sell as high as you can. If you're selling to a corporation, go to the CEO, go to the CIO. If you can't, go to a VP. If you can't, go to a director. In venture, I think there are many benefits to actually selling to anyone, including selling low. In other words, that new entrant who's straight out of school or a few years out of work. But if they're working for a high quality firm that you feel is aligned with what you are doing, there's a lot to be gained as an entrepreneur by selling in over there. So I do encourage you in general to build that relationship, to work with them if all the other checks make sense. But be cognizant that they just may be in a different stage of their career, yet may literally be sitting on $1 billion checkbook, ready and willing and able to write very large checks to your company.
Yeah, well, and you have participated in another one of the programs that I run at Stanford on venture capital training, and so we absolutely have worked with a lot of very brand new investors who are just trying to figure out how to best deploy the capital that they've been allocated. Which brings up a question that came in. Given the lack of professional standards and training and certification required to be a GP in a venture fund, do you think there is a space for some kind of training or certification process for aspiring GPs, or is the role of the VC or the GP so broad and so varied that maybe training and certification like that wouldn't be quite necessary? Or what would you look for as far as maybe a background on a VC that can help you in that way?
Yeah, so I was trained as an apprentice, in venture capital, and I learned sort of, in the traditional way, where someone literally would sit in meetings with me. I would follow her to every board meeting, Catherine Gould. I would follow her to board meetings. And after the board meetings, we would deconstruct the meeting. We would listen to entrepreneurs. We would deconstruct the meeting and say, okay, what did we learn? How did we learn, etc. And at some level, there is no substitute for experience. Experience is this very fuzzy notion of this large amount of contradictory data that you collect, which does lead you to then hopefully make good judgments and be able to then predict things in a more interesting way. So given that background, I'm skeptical that you can really have a certification or a training mechanism, a formal mechanism to complete the process. Can you build a foundation? Absolutely. Is there a benefit to be had through that? Absolutely. And there is a program which is very prestigious and well known called the Kaufman program, which also provides some training, etc. It's not regulated. There's no certification requirement over there, but it does have a good reputation. But they also follow the apprentice model. They are also, while they have some formal lectures, a lot of the learning happens in the real day-to-day meeting. And I don't think we will see a substitute for that happening anytime soon. The biggest threat or the biggest interesting development there really is the application of AI or artificial intelligence to investing. And the question is, how much AI can replace a VC GP, a GP's role, an investor's role in a VC? I think that's an active area. There's certainly a lot of academic research going on over there right now. There are some people who are doing experiments on the periphery of that. But I'm not aware of any firm where there's a black box AI that makes a decision, yes, no decision on an investment. If the next...
At least not a successful firm yet that does that. There might be firms that are trying to do that, but I don't know that we know that it's been proven out as of yet. Yeah.
Exactly. I mean, the best and the most famous firms that I know of all have, living, breathing human beings who are sitting around the table having that conversation and saying, is this the next Steve Jobs? Or is this, the next, idiot who doesn't dress well and smells a little bit when he walks into the meeting? And I'm referring to the actual feedback that Steve Jobs was given after his first meeting with Sequoia Capital about him not having taken a shower before the meeting, and et cetera. So those types of judgments are very subtle, and the thought experiment that I tell people to do is, how do you distinguish between someone who is being persistent and someone who is being obstinate? Give me a test for that. And it's very hard to think of a test. When someone presents a decision to you, or someone says, and is the person being persistent or obstinate? With hindsight, it's obvious. With hindsight, it becomes very simple to know that this person should have given up or should have kept going. But a priori, it's very, very hard to do that. And that is the job of a VC. When someone walks in, my job is to sit there and say that this grand, amazing vision that this person painted, is that a hallucination, or is that really, a prediction about what could be achieved in the future? And reasonable people disagree. Reasonable people disagree on when presented with that information. That's what makes venture so fun. That's what makes entrepreneurship so fun.
Indeed. Well, and you mentioned Catherine a few times, which belies your long relationship with Foundation Capital and all your work there, and then now of course your new firm, Engineering Capital. The question came in: how do I apply for Engineering Capital?
Yes, I'm very easy to find. So thank you. Thank you, Mike. I'm very easy to find. You can find me on the web at engineeringcapital.com, and I have a contact form if you want to fill that out. I do read all the entries that come in through that contact form. So it's easy to find me over there. And you can also find me on Twitter at Ashmeet Sidana or LinkedIn. I'm easy to find on the internet. In fact, most VCs are relatively easy to find. That said, I will caution anyone who's watching that I now have an incredibly narrow focus. Engineering Capital is a labor of love for me. I only do at Engineering Capital what I love doing, which is very early stage software companies that are taking technical risk. And it's primarily in the Bay Area, or certainly in the US, that my focus is. So it's a very narrow practice. If you feel it's a match for that, please do reach out, and I would be happy to review your plan and see if it's a fit for my fund. I'm certainly actively investing right now.
Yeah, no, that's great. All right, so back to the list. Number 3. So VCs aren't rich, but investing in VC will make you rich.
Yes, this is the flip side of the coin for the previous point, which is, so if people believe that all VCs are rich, maybe they also believe that, investing in VC is always a good idea. Look, there's a lot of venture funds out there. And especially in the last 10 years, we've seen an explosion in the number of smaller, newer funds and an explosion in the size of the larger funds. So the total capital going into venture has gone up dramatically. And as Mike, as you also said, right now interest rates are zero effectively. And so you're really competing with zero as the alternative. And everything looks good relative to zero as long as you're not losing money. Here's the sad truth. The average venture firm loses money. The average venture firm actually has negative returns. So, let that sink in. That's a really, really poor investment if you are going to invest in average. Venture capital tends to follow the power law. In other words, all the returns are concentrated right at the top, and they are disproportionately high. In other words, if you can be in a winning venture fund and a winning venture firm, you could make enormous returns, much higher than you could make in a traditional investment, whether in the public markets or even in the private markets. You can do extremely well in those rare funds. But the key word there is rare. And the key word there are power law. And so you really have to understand what you're getting into. And so be very cautious if you are investing in a venture fund. While disproportionate returns are possible, they're very risky. And even the largest, most sophisticated institutional investors rarely invest more than 3, 4, 5% of their entire corpus in venture funds. And so that should tell you how risky it is. You can actually go and see what numbers, I don't know it off the top of my head, what the Stanford endowment, the Yale endowment, et cetera. These are very sophisticated investors who have an infinite time horizon, tens of billions of dollars to invest, and yet they only allocate 1, 2, 3, 4% of their endowments typically to venture. And that will give you a sense for how risky it is. So yes, it can be very lucrative. Yes, it's the only place where you could make 5 times your money, 10 times your money, 20 times your money. Those are not inconceivable. Those happen in venture. Even 100 times has happened in venture in terms of investing in venture funds. But again, be very cautious what you're getting into. This is high risk capital.
Well, and I think, one of the things we talk about in our venture capital training program is that one of the most common job titles in Silicon Valley is a former venture capitalist. Because, yes, indeed, most funds, the average fund does not return. And because of that strong skew, it makes it seem like it's a very, not easy, but a very attractive investment space. And unless you understand that very strong power law, it can seem somewhat disenchanting when it doesn't work out quite right. So yeah, indeed, investing in VC will not make you rich in all cases. All right, number 2, we're getting down to the last couple. VCs know and can give you good operating advice. They can't? You don't know how to run my business for me? Come on, Ashmeet.
This is the default approach that most venture firms took traditionally and continue to take for the vast majority today, which is that we are good operators. We are ex-operators. We used to be CEOs. We used to run companies. We are ex-engineers. We are ex-salespeople. And therefore, we are now good VCs. And so, we will give you good operating advice. I myself was a CEO before. I myself ran product management for a significant part of VMware before, et cetera. And so you would think that I have good operating advice to offer you. And in some cases, yes. But again, the key word there is some, not always. And because VCs will sometimes use their operating backgrounds as a marketing vehicle, as a mechanism to attract entrepreneurs to come and choose them as their investors, they will oversell their operating abilities and the application of those operating capabilities to you as an entrepreneur. And so you have to be very careful when that happens. One of the most painful experiences for me is to sit in a board meeting, to have someone who is a relatively newer VC, someone who's only been doing it for 2, 3, 4 years, who was perhaps a great VP of sales or a great VP of engineering, giving advice on sales or engineering, their supposed area of expertise, to a CEO, and that advice just not being applicable. The situation is different, the technology is different, the company is different, the market is different, the style of the CEO is different, their preferences are different, the culture is different. There are so many things that can be different. And here you have someone who's parachuted in, who thinks their job is to give you operating advice. And because they sit in a position of power, usually VCs will take board seats, they have governance controls, etc. And so people will defer to them, when they give those advice. And it's very dangerous. You really, really should be very cautious, both giving advice if you're a VC and receiving advice if you're a CEO on the operating side. Again, great VCs can do it. In great situations, it is appropriate. And there is something to be had over there. That's why it exists and persists. But don't assume that VCs will necessarily give you great operating advice or that is necessarily the right course of action for your company. You are living and breathing that business day in and day out. The best entrepreneurs leverage the operating advice of the VC rather than take the advice. So for example, I have had great CEOs walk in and say, okay, here's my sales situation. I'm stuck over here. You go make this happen for me. They make the VC work for you. They will have a certain task, a certain introduction, a certain question that has to be answered, and they will make the VC work for you. That is the best way for you to engage as an entrepreneur with the VC. Not as your boss,
and I think,
not as someone who you work for.
Well, and this gets back to the first one we had talked about. A VC's job is to help you. Coming in and saying, I really need help, my marketing isn't working, is very different than saying, I need this one thing. Can you please help me with this very specialized task? So if someone came to you as an investor and asked you to do that, that would not be, you would not feel that was inappropriate or strange. With a very narrow focused thing for which you had a skill set that you could actually complete that for them.
Mike, you framed it beautifully. But the narrower you can make the ask, the more effective the VC is likely to be, and the more valuable the input and more likely it is to be correct in terms of the interaction that happens. Here's a test that you can use when someone gives you advice. How easy is it to disagree with that advice? How easy is it to say no, that it's the wrong answer, and why? How do you feel that way? The easier it is, the better it is, the more useful it can be in that interaction. So if you can narrow something down all the way to, I want to talk to John Smith at XYZ Inc. for this reason, that's obviously perhaps over narrow, but an incredibly actionable way. And someone can say, yes, I know John, or no, I don't know John. And that's a yes-no binary answer at that point. So you need to make it that narrow. Obviously, typically you would have a broader conversation, hopefully a little bit less narrower than that. But that is really the level at which I think operating questions should be discussed with VCs. At the end of the day, you are the CEO, you are the entrepreneur, it's your company, it's your business, and you have to make it successful. The way I like to say is, a VC's reputation doesn't make a company successful. A company's success makes a VC's reputation. So if I invest in a company and that company is the next Google or the next Facebook or the next VMware, of course that makes my reputation as a VC. But just because I invested in companies which have gone public and returned hundreds of millions of dollars and et cetera, and I give you $1 million, that's not going to make your company successful. You have to build your own success out of that.
No, that's a very interesting take that I think, a lot of entrepreneurs think that if I get a really great investment from Sequoia, that's going to make everything that much easier. I'll be able to shop that brand name around. And while that does provide a little bit of, a little bit of confidence and maybe somewhat part of the due diligence for later rounds, no, you have to build your own company. You will make the investor look great. It's not the other way around. And I think that's a really great point. Going back to some of your past history at Foundation, there was a question, what does an operating partner do?
Yeah, so maybe I'll answer the broader question of what do these titles all mean in a venture firm. Operating partner is obviously one popular title. Venture partner is another title. General partner or managing director is probably the most common title that people use. And then sometimes there are hierarchical titles like associate, principal, vice president, etc., that people use. So the short answer to titles in general is it just depends. Every firm has their own culture. There is really no norm around titles, and you have to figure it out. So here's how you can figure it out as an entrepreneur. Usually, a managing director or a general partner title is the real deal, right? Those titles are only given to people who really are general partners or managing directors. You don't hand them out, unless they really are a general partner. And so if you're talking to someone who's got that title, you're done. You answered your question. You really don't have to do a lot more research over there usually. There are a few exception cases of zombie partners or zombie firms, but let's put those in the minority case. All the other titles, they are not equal to a general partner or a managing director. That's why they have that title. And so you have to figure it out for that particular firm, what that title means, and how are they interpreting it and how they are using it. I can't give you a thumb rule for any firm. And what's even worse is that these titles evolve over time. So what happens is firms grow and change, and they still keep using that old title that they used. And so you really have to go ask that person, what does this really mean? And here's a polite way in which you can ask that question, because it's sort of rude to ask someone, sort of what their title really means.
You mean it's rude to ask, are you the real deal? I mean,
exactly. It's kind of hard to ask someone like, your business card doesn't say general partner. Should I be spending time with you? What is the goal of this meeting over here for me? And so, the polite way to ask the question is to say, what is your decision-making process? Okay, not criteria. They'll rarely give you the criteria, but process. And then try to narrow it down to what those action items are. So for example, almost all large firms almost inevitably have a partner meeting as usually the tail end of the process or perhaps the very last step of the process. Okay, so you really want to understand, well, what do I have to do to get a partner meeting? And what does it take, how will I know that you are ready to give me a term sheet or you will give me a term sheet? The outcome of a conversation with the VC that you want is a term sheet. That is the tangible, physical outcome, which is success for you as an entrepreneur. And so you really want to map that process out. And questions like, how long will it take? What is the next step? How many steps are there? Those are all polite ways of really understanding it. And you owe it to yourself as an entrepreneur to be crystal clear about it. Do not leave any meeting with a VC without knowing what the next step is. Otherwise, you just wasted your time, because, it is in the VC's interest to take meetings. Our job is to meet entrepreneurs, and we can walk away saying, oh, well, I learned about one more business. I learned about a new market. I learned about a new product. I learned about a new team. And that's a net positive for me. For you, it's a net negative. You just taught someone about your business, about your market, and you may not get anything out of that return unless it progresses to a term sheet or, in some rare cases, advice that you may get out of that. And so you really want to stay focused on the goal and keep it in a very sales-driven process. There's a thumb rule in sale, ABC, always be closing, right? You have to follow the ABC principle. It's like, okay, what are the steps to a term sheet? Because if that's not happening, you're not clear what you're doing. You're just wasting your time.
Yeah, and just to be clear for everybody, at Engineering Capital, Ashmeet is the real deal. You don't have to know that's in fact the case. All right, so our final.
I do want to make one more point on that. It's a really important point you bring up. In my case, I'm the only partner, and so it's very easy, and I have fun with the title over there. Some firms will deliberately obscure who the real partners are from from sort of the more assistants or helping partners by using generic titles like partner for everyone. When everyone is a partner, there are some people who carry the partner title who are not partners. Your job as an entrepreneur is to figure that out. So I'm sorry, it's unfortunate, but it's just part of the landscape. That's how the industry has evolved. And there are good strategic reasons why it helps the firms to do it. And so I do believe this behavior will persist And you will see more of this, not less of this.
Yeah, indeed. All right, and our number one thing, and you seem like such a friendly guy. VCs are your friend. Not true?
Thank you, Mike. I'll take it as a compliment that you think of me as friendly. And let's face it, most VCs have a good demeanor. We choose for good interpersonal skills, good relationship skills, because it's a relationship business. That is what allows us to work with entrepreneurs who are working in a very stressful situation, who are taking on a disruptive, difficult task that they are trying to build from in an environment that is by definition difficult. That's why it's interesting. If it was easy, it wouldn't be lucrative. It would not have high returns. And so in an environment like that, our job is to be the friend of the entrepreneur, to work with the entrepreneur, and to keep those relationships. But the fundamental relationship is not that of a friend. And I think entrepreneurs sometimes get fooled by that because we work like this, because we are very informal, because we are casual, because we're always doing dinner or beer or hanging out, or and it's and to some extent because especially in California, our interpersonal, our working styles are very casual, and that sort of breeds this feeling that they are your friend. And I'll circle this all the way back to the very first example I gave, where Benchmark was suing Uber or threatening to sue Uber. Or that is not something that friends do to each other. You don't stay friends if you do that. And so, so if a VC is not your friend, then what is your relationship with your VC? And I think you can be clear, and you should understand that. Number one, clearly he's your investor. He or she is sitting on your cap table, and when you talk to her, at the end of the day, she's your investor, he's your investor. They're looking at it as a shareholder in the company. But they may also be your board member. And so they may have a governance role with you. And you have to be aware of that power dynamic as a board member. They may be your partner in the sense that you are aligned in your long-term goals. They want the company to succeed. You want the company to succeed. You are aligned. And so you could build a partnership where you are a team, where they can be a thought leader with you, perhaps a sparring partner with you, who can work with you in that role. Perhaps they are your mentor. They have a lot more experience. And while I was dissing the experience earlier in terms of it's not always applicable, let's face it, I've got gray hair, I've fought a lot of battles, I've seen a lot of issues come up, and I may be able to give some advice, which is useful. And so they could be a mentor, and you can have a mentor-mentee relationship over there. You should be aware of those things. They may also be your competitor. Okay, they have a portfolio. They may have an investment, and it sometimes happens explicitly or implicitly that they have a competing investment with yours. So you have to be aware of that. They may be your enemy. Your goals may not be aligned. Okay, which is how you may end up eventually literally fighting each other, but they can become your enemy. And you do see very stressful situations in boards where it is clear that the goals are not aligned, and therefore there is a political situation, a power situation, and they are your enemy over there. So there's an entire range of relationships that can develop over there. And I think your job as an entrepreneur is to always understand what is the current relationship, what is the best relationship, how best to benefit that and grow with that, remembering that it is an extremely rare chance that they are actually your friend when they have that relationship.
And I started off by saying that Ashmeet seems so friendly, and it is wonderful to have him as a friend. Thank you very much for joining us for today's webinar, and these sort of top 7 myths to try to demystify a bit of venture capital. Please check him out at Engineering Capital, the fund that he runs. Anita, I'm going to hand it back to you for just a short wrap up.
Very quickly, I want to thank you, Mike and Ashmeet, for this very eye-opening, revealing, honest conversation. It's been very helpful. I think it's giving some insight, many insights. And before we go to our audience, if you'd like to learn more about the Idea to Market Entrepreneurship Program, you can click on the button on this page. The next session will begin on August 30th. Thank you all for joining us today, and we wish you a very great day. Thanks.
Thank you, Mike. Thank you, Anita.